Recording on कर रहे? Good evening, everyone. Myself, Shweta Jain, Secretary WIRC, welcome you all on program on auditing standard, which is generally known as a very dry subject. And but I'm really happy to see you all in joining this this evening today in large number. So before moving further, I request everyone to put your hand on your heart for the ICI motto. Mishra ji?
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Thank you. Today we have with us CA Harsh Batra, who is a faculty for today's workshop and webinar, and also a treasurer WRC CA Piyush Chandak. In absentia of our chairman CA Murtaza Kachwala, let me take the privilege to give you just a highlight, or I can say about our activities of WIRC for this year. So under able leadership of our chairman, CA Murtaza Kachwala, we all council members are trying very hard to achieve our goals, which we have set out for ourselves when we took the charge. And this year, our major and mainly focus is on more of technology-oriented program and a lot of refresher courses and workshop. Since we all know that technology, how it has evolved over the period, and our profession is also no exception to it. So sooner or later, we have to accept it and we have to adopt the technology in our profession also. So keeping this in mind, this year, a lot of technology-oriented program we have conducted, seminar, webinar, conferences, 1 day, 2 day. Some courses specifically designed data analytics courses, part 1, part 2, Tableau, Excel, Tableau, Fusion, artificial intelligence, robotics. So everything and all the informations are available on our WRC website and also on our YouTube channel also if the program was conducted in virtual format. So a lot of refresher courses just because of we know that if we want to increase efficiency in our work, so of course depth knowledge is required. So today is also the one program on auditing standard. The purpose behind of this only that how we can increase efficiency in our reporting. Ignorance of applicable auditing standards can make members liable to the disciplinary action that we all know that. So if I can say that if we chartered accountant want to command an audit profession, of course, auditing standard should be understood and we have to should be fulfilled in a full spirit. And for that, we have today with us CA Harsh Batra to know more about from her. I request before handing over charge to her, I request to Treasurer WIRC Piyush Chandak, please introduce her.
Thank you, Shweta Madam. Hello, Good evening, all of you. This is CA Piyush Chandak from Nasik. Presenting before you, CA Harsh Batra. And before that, I would like to take a cue from our Secretary Shweta Jain ma'am, as rightly said by her. The auditing standards, study of auditing standard is important because we have to follow them very strictly. We have to adhere them very strictly now because the days have changed. The days have changed so badly that we can say हमारा जिक्र भी अब जुर्म हो गया है गालिब. हमारा जिक्र भी अब जुर्म हो गया है गालिब. दिनों की बात है, महफिल के आबरू थे हम. So ये our profession is facing this turmoil because we have lost. It seems like we have lost our credibility in the eyes of regulators and all, and we are facing more and more actions nowadays. So if we stick to our standards and if we study our standards and follow them rigorously, I think this can be avoided and we can come out with the large and bright colors. So with this, I give a small introduction provided by our speaker. She has done her articleship from one of the big four and have more than 6 years of post-qualification experience in one of the big 5 firms, including 5 years of experience in statutory audit and more than 1 year of experience in handling risk and quality team. So she is also actively involved in internal firm trainings. With this brief introduction, I present before you CA Harsh Batra. Thank you. Over to you, madam.
Thank you so much, ma'am, and thank you so much, sir. So for the such a humble introduction, and thank you, for giving us this opportunity to present a very important topic amongst all our members. So without wasting much time, I'll just share my screen. Sir, can you check? It is showing the screen sharing is disabled. Yeah, fine.
Is it enabled, ma'am?
Yeah, it's visible. So is my screen visible?
Yes, I guess. But
अभी आप शेयर नहीं किया, शेयर कर दिया आपने, क्लिक करिए शेयर पे. हाँ, अभी आ गया.
Yeah.
Yes.
Yeah.
Yes.
So okay, so let's now quickly start with the topic of today's session, which is on the reporting standards. So we all know that that SA 700 series deals with the standard with those requirements which are basically pertaining to the reporting in the audit report. So which obviously includes SA 700, which lays down the format of the report, SA 705, 706, 701. So all these standards basically deal with the various requirements with respect to the reporting in the audit report. So let's quickly see that what are the various topics that we are going to cover today. So we'll start with the flow of audit report. Then we'll briefly talk about SA 700 and SA 705. Then we'll move on to EOM and other matter, which is governed by SA 706. Then we'll talk about the reporting of going concern matters in the audit report, which is governed by majorly SA 570. Then we'll see quick points with respect to auditor's responsibility with respect to other information, and why we are going to discuss in today's session, because there is a specific para in the audit report which requires the auditor to comment on the other information in which financial certain figures of financial statements are there. Then we will talk about the new reporting requirement, which not as such new now. We have already passed 1 year, which was Rule 11E and 11F. So March 22 was the first year of reporting with respect to that. Then we'll talk about some other matters included in the audit report, and then lastly we'll talk about CARO reporting. So let's start. So SA 700, again, we all know it deals with the auditor's responsibility to form an opinion on the financial statements. It lays down the format of the audit report. It lays down the content of the audit report on the financial statements. Then SA 701, again, we all know that it deals with the auditor's responsibility with respect to key audit matter, which we generally call it as CAM. Then SA 705 deals with the auditor's responsibility with respect to modification in the audit report, and we'll discuss different types of modification in the report. Then SA 706 again it deals with the requirements of emphasis of matter and other matter. So this was the quick introduction. So let's quickly see the format of the or flow of the audit report. So we start with the title. So generally, the title, is governed by the nature of the report. Like generally, it is independent auditor's report, right? And followed by that, we add addressee. So which basically means to whom that particular report is addressed. So it can be to the members of the company, or it can be to the board of directors. So it will be governed by the applicability and the purpose for which the report is prepared. Then we start with the opinion. That is one of the first again paragraph. After opinion, we write basis of opinion. So in case we are giving a qualified opinion, then we'll have to write basis for qualified opinion. And in case we are giving, say, disclaimer or adverse opinion, then we'll have to mention the basis for adverse or disclaimer opinion as well. Followed by that, in case there is an emphasis of matter, which is which as an auditor we are reporting in the report, then we'll put that emphasis of matter. And then material uncertainty related to going concern. So this is again very important. It is actually a material uncertainty related to going concern, not an EOM. So we as professionals, we need to be mindful of that. A few years back, ICI made this amendment, and we need to be careful of that. Now we are not referring the matter. If in case we are reporting material uncertainty, then it is not an EOM, but it has a separate heading, and it is governed by a separate SA, which is SA 570. Then in case the key audit matter reporting is applicable, then we'll have to add the key audit matter. And after that, we'll put a paragraph on information other than financial statements and auditors report thereon. So here the auditor is basically supposed to write what is the responsibility of management and what is the responsibility of the auditor with respect to other information. Then we start with the management's responsibility and then auditor's responsibility, and again, management responsibility and auditor's responsibility includes various aspects, like with respect to, if we talk about management, then it is with respect to the preparation of the financial statements, compliance of the financial statements with the applicable financial reporting framework, which can be Ind AS or which can be AS. And also very important, management is also responsible for ensuring that entity would be able to continue as a going concern. Similarly, for auditor's responsibility, again, there are a couple of points mentioned in the report for which the auditor is responsible, which includes that we are responsible for giving a true and fair view opinion, and also we are responsible to check management assessment with respect to going concern. Then after that, in case there is any other matter which warrants reporting, we'll go to that. And then it is on report on other legal and regulatory requirements. We'll look into these requirements in detail in the later part of the session. And then we close the report with the signature, UDIN, place and date. So again, we have to be very mindful that sometimes we think that all these aspects may not be important, but from quality perspectives, these are very crucial. Again, as a separate UDIN is required for each assurance opinion. So make sure that UDIN is generated as per the requirements of the ICI, and that is mentioned in all the opinions that we are signing, along with the place and date. And obviously the name of the partner and the membership number of the partner who is signing, and also the in case it is the partner is associated with any firm, then the name of the firm and the membership number of the firm is also required to be mentioned in the audit report. So now let's see few examples, or let's see SA 700 and 705 bit in detail. So 700, we saw that it lays down the content and the form of the audit report, which we have just seen. Other than that, SA 700 would be generally applicable when we are issuing an unmodified opinion. So when the unmodified opinion is issued, so basically if we conclude that based on the work done, based on the audit evidences which we have obtained during the course of the audit, the financial statement as a whole are free from the material misstatement. So in case we have not identified any issue, we have not identified any misstatement, then generally we issue an unmodified opinion. Or in case but in case we are unable to obtain sufficient appropriate audit evidence to conclude that that financial statement as a whole are are free from material misstatement, then we will have to modify the opinion in accordance with the requirements of SA 705. Then what are different nature of modification in different situation. So this particular slide, it is very important. It is something we all studied when we were actually students. So I remember when we had this essay in even in our educational material, or even in our books. So this particular table was always used to be there, and it is still very much relevant to determine that which type of opinion or which type of modification is required to be issued. So so in case we say that financial statements are materially misstated, but that misstatement is so that misstatement is material. So that is why we are moving towards modification, but it is not pervasive. Then we move towards qualified opinion. But if that misstatement is material and it is also pervasive, then we have to do the evaluation with respect to adverse opinion. So this is again practically it is very important. So just be mindful that in case you are at a situation in which there are multiple qualifications in the report, then it is very, very important to have documentation in place to conclude that that all these multiple qualification does not have adverse impact on the audit report. So make sure that is there in the there in your documentation. So I'm not saying that in all the cases where there are multiple qualification, it will always have pervasive impact, but generally such situations warrant analysis from the auditor, that even though there are multiple qualification, but the impact of such qualifications may not be pervasive. So even in fact, this is also possible that there is only one qualification, but the impact of such qualification is like so pervasive that it warrants adverse opinion. So what we can do as an auditor with while while concluding between whether it should be a qualification or adverse opinion, we need to determine the impact of we need to determine the impact of qualification on the overall financial statement. So if say you're qualifying with respect to any financial statement areas, which is a very significant part of that of the financial statement as a whole, or it is in such nature that it is impacting other financial statement line items as well, then the your conclusion may move towards adverse opinion. So we'll see a few examples with respect to that, to have better understanding. Then inability to obtain sufficient appropriate audit evidence. So this is a situation in which the management did not provide us the sufficient appropriate audit evidence to form an opinion on the financial statements. So again, if the impact is material of not having obtained those audit evidence, but it is not pervasive, then we'll give a qualified opinion. But if the impact of the absence of the sufficient appropriate audit evidence is material and pervasive, then again it warrants the disclaimer of opinion. Then differentiating between qualified and disclaimer of opinion, again it is as important as we discussed for differentiating between qualified and adverse opinion. And at the same time, it is very important to differentiate between the adverse opinion and the disclaimer of opinion as well. So whenever there is a situation of absence of audit sufficient appropriate audit evidence, it is more of a situation for disclaimer of opinion, and if the impact is pervasive. So are we good to go till now? I'll just move on to the next slide. We can take up questions at the end. So again, I just want everyone to participate a little bit. Any examples of qualification, in case you people would have seen practically on ground while doing your engagements? There can be many examples for qualification. So I would like to everyone to participate. It should not be like maybe one person speaking and others only listening. So okay, so Gaurav Batra replied that valuation of inventory not as per standard. So yeah, that means non-compliance with any accounting standard is an example for qualification. So again, Gaurav, in case the valuation, the impact of inventory being misstated is something you need to evaluate. If the inventory is misstated, then it can impact your cost of material consumed. It can also impact because the cost of material consumed is generally a balancing figure of inventory. So if you're not comfortable with the inventory, please always evaluate the impact of such statement on the overall financial statements to conclude that the impact is only material and not pervasive. Not being a going concern, yeah, so we'll discuss about going concern in detail, maybe later on. So that time we'll understand in which situation we can give you a qualification on going concern. So non-compliance with laws and regulations, correct. So you have to evaluate the impact of such non-compliance before again concluding that it warrants a qualification. So in case the impact of non-compliance is not material, the penalty or the interest that may be imposed on account of such non-compliance is not material, then it may not warrant a qualification. But if it is material, then definitely it is an example of qualification. Then good, thank you everyone for participating and for giving quick answers. So now let's see a few examples. So yeah, so here, based on some audit reports which are available on public domain, and based on some of my practical experience, I've highlighted certain examples. So you guys highlighted correctly, non-compliance of any AS and AS, it will warrant a qualification. For example, in case someone said in the group that non-compliance of laws and regulation, so FEMA is one of the, significant regulation which is applicable to a lot of organization. So in case the company has not complied with those provisions, then it can be an example of non qualification. Then gratuity actuarial valuation. So in case the company is governed by the provisions of AS 15, then but it is not getting the actual valuation done as per the requirements of the standards, then it can be a potentially a case of qualification. And one of the common qualification which is there is on qualification on impairment of assets. So a lot of times, the company is having, say, going concern issues, they are facing cash crunch, their business is not growing, but they are still, they are still valuing their assets at their cost, and they are not doing the impairment assessment. So in case the situation warrant impairment assessment, but we are not getting such documentation from management, then it can also be a potential case for qualification. So thank you everyone for participating. Then now, let's see some illustrative language for that. So this is a case wherein we have audited financial statements of a company. The qualification is basically pertaining to so if we read through that, the qualification is pertaining to the valuation, incorrect valuation of the inventory. So we just saw that the format of the audit report. So we need to start with the qualified opinion, and then we have to give the basis of qualified opinion. So herein I just highlighted that whenever we are giving qualified opinion, we have to write that in our opinion and to the best of our information and according to the explanation given to us, except for the effects of the matter described in the basis for qualified section of our report. So that is something which will get repeated at a lot of places. So you need to carefully evaluate that. So we'll discuss in detail the other reporting under 143.3. So there also at some places you will have to evaluate whether you want to give exception to the matters described in the basis for qualified opinion. Then you will have to in the basis for qualified opinion, will have to state the actual facts, like why we are moving to why we are particularly qualifying that financial statement line item. So this example basically clearly highlights the extent of to which the facts should be there in the audit report. So one thing we need to be very careful of as professional is it should not be a storytelling. It should not be like we are writing everything in the qualified opinion, but we have to apply our professional judgment, and we have to bring in relevant facts and other things which through which a user can easily understand that why this matter was qualified. And always end the qualification with a specific reference to the relevant note in the financial statements. So like in this example, you can give reference to the to the note under which the inventory figures are being presented, and also you can give reference to the note for in which the accounting policies for inventory are defined, because there also we would have written that inventory is valued at only cost and not cost or NRV, whichever is lower. So this is something which is important from the perspective of the drafting of the qualified opinion. And also one very important thing, in case a qualification, again, if it is a qualification, it is on serious non-compliance only. So it should be a factual reporting. It should not be like that we are covering things up by reporting something and the facts are and the facts are different. So that is also something very important, and this is being particularly highlighted by NAFRA in one of their report, that sometimes the reporting of qualification or even EOM is done in a very softer manner, but the underlying issues were very serious. So again, we need to be we need to be a bit mindful of that. Second, so I told you that you need to give reference to the note in the relevant note in the financial statement. So always make sure that the qualification and the relevant note are speaking to each other. They are inconsistent. So we understand that notes are the responsibility of the management. Financial statement is something which, responsibility of the management. But at the same time, it should not be like, we are qualifying it here, and in the note given by the management in the financial statement, they are saying that, everything is okay, everything is good. So it should not be like that. They should be consistent with each other, including the figures. So in case your qualification which you are writing involves reporting of figures, so make sure the figures which we are reporting in the qualified opinion, they are reconciling with the financial statements. So these are all, again, may sound very minor, but qualitatively these are very, very, very important points. And because, this is something, this is a deliverable which goes to regulator, which goes in public domain in case of, the listed or the public companies. Now we take see, we are seeing few example of disclaimer of opinion. So they can be again many example, and it will determine by case to case. So here for disclaimer, we have given example. Say management is, not giving us access to the financial statements, including, and they are restricting us to communicate with the component auditor, and wherein, the component is a significant component. So highlighting that the component is representing 90% of the, group assets, that means it is a significant component. But we were not provided with the financial statements of such component. Then because that component is representing 90% of the group assets, that means we have obtained audit evidence only with respect to the 10%. That means the impact of not getting such information or audit evidence is pervasive. Hence, it warrants a disclaimer of opinion. Then for adverse, it is a very important example. So in case, the entity's financial arrangements are expired and management is not able to get the refinancing, they are not able to get into the renegotiations with the financial institution. So that means there is a lot of uncertainty on the, manage a company's ability to continue as a going concern. And financial statements do not adequately disclose that fact. That means it is a case of adverse opinion and not only a qualified opinion. So that's why I said earlier that going concern is something that we have to evaluate very carefully. It can be a qualification, it can be only a material uncertainty in few cases, or it can be adverse opinion in such cases, wherein, the going concern assumption is not appropriate, management is not agreeing to our view, and so they are not disclosing the fact of going concern being not appropriate, and hence, it warrants adverse opinion as per the requirements of SA 570. This is again the guidance which is there in SA. So in case, there is a scope limitation which has been imposed by management. So practically, okay, the SA says, we should consider either withdrawing from the engagement, or giving a disclaimer of opinion in such case. But practically, be careful that do advocate discussions with the management and those charged with governance. Raise your issues to them, so that where the scope restriction is imposed, what kind of audit evidences they are not able to provide. So that is something which has to be there as a part of our documentation. And then we need to determine if the possible effects of the undetected misstatement is likely to be material and but not pervasive. So in case, again, it is a scope limitation which can lead to a material misstatement, but it is material and not pervasive, then we'll consider qualification. But if the possible effects of the undetected misstatement is likely to be both material and pervasive, then we need to consider withdrawing from the engagement. But at the same time, there is a guidance which is issued by SEBI with respect to resignation from the listed engagements. So please refer that before taking a decision or withdrawing from the engagement, because now it is not very easy for us as well to move out from such situation. So in case we are stuck in such a situation, make sure that we have advocate documentation in place which substantiates that we did advocate follow-ups with those charged with governance and management. And after that, the relevant decision of withdrawing was taken. And in case we are at a situation, for example, if as per SEBI regulation, we are not in a position to withdraw ourselves from the engagement, we need to give a disclaimer of opinion. Okay, fine. So we'll move on to now, let's see a few examples for EOM and other matter. So before getting into example, let's understand in general or in basic that what do we mean by emphasis of matter or other matter, which are governed by SA 706. So SA 706 deals with the additional communication in the auditor's report. So when EOM is warranted, so basically, when as an auditor, we want to draw an attention to a matter which is presented or disclosed in the financial statement, which are fundamental to the user's understanding of those financial statement. So again, these are very keywords. This is something, we have to apply in our day-to-day work. Like, it should be relating to a matter which is disclosed and presented in the financial statement. And it should be, important to the user's understanding of the financial statement. Now, if we go into the essay, they have given certain examples also, which can fall under the potentially under the definition of the EOM. But one very important point is that emphasis of matter is not a substitute for a modified opinion. In case we are in a situation that that a qualified opinion is warranted, we have not obtained sufficient appropriate audit evidence, or we have identified a material misstatement which warrants a modified opinion, then EOM cannot be a substitute for that. It is also not a substitute for a disclosure in the financial statement to achieve the fair presentation. So, anytime when management tells you that, you guys are reporting in the audit reports, and then why I'm supposed to disclose in the financial statements, then it is not acceptable. The financial statements are a separate document. Those are that is something which is prepared by management, and management takes the ultimate responsibility for that. But auditor's report is our document. In case something we want to draw our attention to, then that is our document. So it is not a substitute for anything which is required to be disclosed in the financial statement. It is also not a substitute for reporting in accordance with ISA 570, which we discussed before. Now, other matter, other matter also we are drawing attention to any matter which is other than disclosed or presented in the financial statements, and which is also relevant to the user's understanding of the audit. So again, if we try to understand the difference between them, so then in this case we are drawing attention to something which is already there in the financial statement, and which is important for understanding of the financial statements. Whereas in the other matter, we are drawing attention to a matter which is relating to our audit, and it is not we are not drawing attention to the financial statements in this case. So so other matter does not include the matters which are required to be disclosed or presented in the financial statement. Again, it does not include any information which is required to be provided by management statement, to be provided by the management, and it does not include any information which is prohibited from providing by law or regulation or other professional standards. So again, other matter also is not a substitute for EOM or a modified opinion. It is not a substitute for any disclosure which is required to be made in the financial statements. So let's understand this better by looking into some examples. These are the various circumstances under which the EOM can be given. So uncertainty relating to the future outcome of an exceptional litigation or regulatory action. So I'm not going to give examples as of now. Let's discuss that later. Any significant subsequent event that occurs between the date of the financial statements and date of the auditor's report. In case a company is going for an early application of a new accounting standard that has a material effect on the financial statement. Then lastly, a major catastrophe that has or continues to have a significant impact on the entry's financial position. A very classic example of this is COVID-19. So I think in past, most probably in March 22 financial statements, we would have seen a lot of companies putting this, emphasis of matter, because at that time the the impact of COVID-19 was very uncertain, and hence, and we were not aware about the future, what may happen in the future, and hence it can be a very common example of EOM. Then I highlighted that one of the regulators' observation was that EOM was inappropriate, and it was a soft reporting of a serious matter, of a matter which warrant qualification or even adverse opinion. The conclusion of the auditor was to give a EOM. That is an inappropriate use of EOM. And also, it is being highlighted by regulators sometimes that use of too many EOM in the audit report is also not something which should be happening. In case it is resulting into that, then we need to sit back and think about it, that are we going into the right direction? Are we actually giving the matters which warrants EOM, or these are the matters which warrants some modification? Okay, again, everyone, if you guys would like to share some examples of emphasis of matter. So I want everyone to share a few examples of emphasis of matter which you guys would have you know maybe faced practically. Yeah. So I'm looking for examples of EOM. Okay, going concern. So when going concern will warrant a EOM? Okay, so someone said negative net worth and and negative current liability position. So again, this is also an example of going concern. We'll discuss going concern maybe in more detail later to have better understanding. Again, going concern is something which we will discuss later. Someone also wrote long tax outstanding, uh, not paid, and CARO not applicable. Again, it is very judgmental that whether it should warrant EOM or it should warrant a qualification. Then someone said if provision for gratuity not made. Again, very careful. Provision for gratuity not made, and if the impact of non-provisioning is material, then it can be a qualification and not necessarily a EOM. Okay, so someone correctly highlighted preparation of financial statements on realizable value basis. So correct. In such cases, we may want to draw the user's attention to the financial statements to the basis of preparation para, in which we would have written that financial statements are prepared on a net realizable value basis, and hence EOM is given. So that is the only circumstance when EOM would be given with respect to going concern, and it is actually not related to going concern. It is relating to the preparation of financial statements on net realizable value basis. Also, someone rightly said significant litigation which might be of importance of users that will, warrant EOM. Okay, fine. Thank you so much, for interacting. So, thank you for giving some very classic examples. So let's see a few examples now. 1 second. Yeah. So impact of COVID-19, again, someone said in the group, pending litigation, then maybe, some non-compliance relating to Companies Act, which is not material. So again, this is very important. provision for gratuity not made, but if the impact of such non-provisioning is material, then it is a case of qualification and not EOM. A lot of times we see, that there are some merger demerger happening in the company, and specific type of accounting has been applied, which was prescribed by in some NCLT order. Then it is can be a matter of emphasis of to which we may want to draw attention. Then effects of the fire, again some uncertain event or that happen, of which we may not know the outcome of such event in the future. Then one of the example which I have given here is recognition of any income on a expense subject to variation in the rates by authorities. So this is again very 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 typical example. Please carefully evaluate that. So in case sometimes companies are subject to certain incentive based on certain rates which are prescribed by the government, and those rates gets prescribed maybe in a particular part of the year, and before that management uses certain basis to recognize the income. So it can be a potential case for EOM. But again, when management is estimating that basis for recognizing that income, we should carefully evaluate that basis. We should be comfortable with that basis. In case we are not comfortable, then it can be a qualification also. This is illustrative language. So there are two examples here. First is, in case, that in case there is an event of fire which has happened, which has happened subsequent to the year end, and the impact of event is such that as an auditor we want to draw the user's attention towards that, then we can give an EOM. But even here we have mentioned that the matter did not require in this case also we have mentioned that. So we can give a EOM on that by writing that we draw attention to note access to the financial statements which describes effects of the fire in the company's production facilities, and our opinion is not modified in respect of this matter. So again, highlighting in this in that fashion is very important. So in the qualification we generally describe the matter and give a reference to the note later on. But because EOM is just is a matter in which we are actually drawing attention to the financial statements, we need to start it with in the same way that we draw attention to note excess of the financial statement. It should it should briefly describe the matter. It should not cover up anything. Again, like qualification, it should state the facts which can enable the external users to understand the nature of the EOM. And again, the note reference has to be correct, and note reference has to, again, the language in the EOM should be consistent with what we are talking about in the note as well. And because EOM per se is not a modification, hence we conclude this that it is a not modified, our opinion is not modified in respect of this matter. Then another example which I've given here is with respect to pending litigation. So again, I've given facts that that it is at initial stage, and as of now management is certain with respect of the merits of the case. So that means it is a matter only to which we want to draw the user's attention, but it is not having any adverse impact on the company. Then hence we are concluding this matter with the EOM. So again, you describe the facts briefly, you mention the amounts as applicable and make sure those amounts are reconciling to the financial statement. And then lastly, you conclude the EOM with that your opinion is not modified in respect of this matter. Then let's see certain examples of other matter. But before I see those examples, can you quickly give some examples of other matter which you guys have seen practically? So since our session is only for limited time period, I just appreciate everyone can quickly respond to that. An example of other matter. Okay, correct. Subsidiary audit not done by us. So in case, in the consolidated audit report, we have not audited certain components and those are being audited by another auditor, we can highlight that in the other matter para as a division of responsibility. In case of issue of revised financial statements, okay. Yeah, so right. So same for subsidy will be applicable for branch audit as well. Fine, thank you. So let's see a certain example. That physical verification. So again, this was the other matter which was put in maybe in the COVID situation. But again, this is an example of again which will be we have to evaluate if it is relevant, in your case. So in case we could not perform the physical verification, but we were able to obtain the audit evidence through alternate audit procedures, only then we will give a other matter. But in case we were not able to perform even other alternate procedures to obtain comfort over the inventory, then it can be a potential matter for qualification and not other matter. Then other matter in the audit report on consolidated financial statements, so someone in the group rightly highlighted that then financials audited by another auditor in previous year. Again, in case we are doing the audit for the first time and last year the audit was done by the predecessor auditor, then that is something we also highlight as a part of other matter. Then the comparatives are not audited. So again, this is something you need to evaluate on facts to facts basis. So for example, you are giving any special purpose report of which so management wants the say financial statements only for September 22 and the September 21 figures are not audited. But these are special purpose financial statements which are prepared for some specific purpose. Then you can give that that comparatives are not audited. But in case of general purpose financial statements, it can be a matter of qualification. So although as an auditor we are required to do opening balance testing, but this is something you need to evaluate very carefully whether it can be a only other matter, or again you need to do some more work to conclude that if it is only other matter or it warrants a qualification. Now let's see some illustrative language for other matter. So this is relating to the one which was correctly highlighted by one of the attendee. So in case the branches are not audited by the auditor, but reliance is being placed on the report issued by the branch auditor. So again, you need to state the the composition of that branch. What is the total assets, total revenue, contribution of that branch in the standalone financial statements, and then you can again we write it factually that these are being audited by the branch auditor and we have relied on those reports, and based on that we have formed our report on standalone financial statements. And then lastly you conclude this with that the CARO opinion is not modified in respect of this matter. Then this is also the example on the consolidated audit report or audit report on consolidated financial statements. So here we write that the subsidiaries or the jointly controlled entities or say other associates which reflects again this is very important to mention that we need to specify the total asset contribution, revenue and cash flow in the total consolidated financial statements, and also its contribution in the group's total net profit and loss. And then we are highlighting that then we are highlighting that these have been audited by other auditor whose report has been furnished to us by management, and our opinion on the consolidated financial statement in so far relates to such amount is being based on the report, is solely based on the other reports of the reports of the other auditor. So this is something which should be brought in the other matter correctly. uh, then let's see another example. So this was the one in which we relied on the report of the other auditor to issue opinion on the console financials. Second is that there are certain components, there are certain subsidiaries or associates which are not audited. So in that we mentioned the additional line on that these financial statements are unaudited and have been furnished to us by management. A very important aspect with respect to this reporting is that last statement which says that in our opinion and according to the information explanation given to us, these are not material to the group. So make sure that in case it is a situation wherein certain group component parts of certain part of the group, so some subsidiaries or associates are not audited. So make sure that those are not material. And how you determine materiality is there is a separate guidance, and you know the literature on that. There is a guidance note issued by institute on the consolidated reporting, so you refer that before concluding on that. Then SEBI has a separate guidance, that it requires us to it requires the group auditor to have audited certain percentage of the total assets, revenue, and profit or loss. So make sure we abide by that before we put this para. In case there is a significant component which is not audited, then it can warrant a again qualification, or as we saw earlier, it can be a adverse opinion also. So make sure that when we are writing the statement, it is not material to the group. Our documentation reflects that that these components were actually not material to the group. Now here you guys can also see that it is giving the reference to financial statements or financial information. So that is something also we need to carefully use. In case these are complete set of financial statements, then we can use financial statements. But in case it is say it was a foreign subsidiary or a foreign associate, and we were given only say balance sheet, P&L, and some notes of that of that of that foreign subsidiary or associate, then it can be a then it is a financial information, when it is not a complete set of financial statements. So make sure we use that terminology carefully. Then lastly, in case so it is a similar same example which we are continuing. So there was another matter on this one which we saw. Then this is a second other matter. Then you need to again conclude with respect to other matters as well, that our opinion on the consolidated financial statements with respect to this matter is not modified. And also we are giving reference here that our report on other legal and regulatory requirements is not modified in respect of above matters. So we are giving reference to both our opinion on the financial statements and also our reporting on the other legal and regulatory requirements. So with this, we are done with the EOM and other matter. Let's quickly see certain reporting requirements with respect to going concern. So again, this is a very basic concept that again, we maybe studied first time during our when we were students actually, that financial statements are prepared on the assumption that entity is a going concern and it will be able to continue its operation for a foreseeable future. And hence a lot of responsibility is being placed on the management and also on the auditors auditors as well. Management being responsible for performing the assessment that they will be able to continue as a going concern, and we are responsible for ensuring that assessment is correct. Then general purpose financial statements are prepared using the going concern basis, unless obviously management intends to liquidate, and they are preparing financial statements actually on on realizable value basis. Then special purpose financial statements may or may not be prepared on in accordance with the financial reporting framework, but a going concern assumption will always be relevant in that case as well. So again, this is something very basic, and we all know that. Then lastly, when the use of going concern basis of accounting is appropriate, the assets or liabilities are recorded on the basis that the entity will be able to realize it, the assets, and discharge its liabilities in the normal course of business. Again, this is something basic that we are or we already are aware of. Then again, coming back to the topic, which is the reporting of going concern. Then if we talk about that, then the auditor, again, as an auditor, we are responsible to obtain sufficient appropriate audit evidence to conclude that that the going concern accounting assumption is appropriate. So what if the going let's see few different situations. So first is if the use of going concern basis of accounting is appropriate, and no material uncertainty exists. That means there are no financial or other indicators. The company's net worth is good, their business is going good, their revenue is increasing, they are not into losses. No such financial indicators and no other operational indicators. No government regulation which is imposing the restriction on business. That means it is an unmodified opinion. No reporting is required in the audit report. Second situation can be the management, is not having sufficient plan in place to continue its business. They don't have the advocate support, maybe from their holding company or maybe from the promoter, and their current financial position is very bad, then it is a potential matter for even qualified or disclaimer of opinion, because in this case the auditor is unable, is not in a position to obtain sufficient appropriate audit evidence. Again, use of going concern, a third is again very is something that we discussed, that use of going concern basis assumption is not appropriate, and financial statements are prepared on the alternate basis, then that can be a matter of EOM. Otherwise, EOM and material uncertainty are two different paragraphs. Last example also we discussed there, wherein financial statements are prepared on going concern basis, but the going concern assumption is not appropriate. Then it is a adverse opinion. It is irrespective of the fact that whether financial statements contains a note on that. So if it is a situation where management and us and the we as an auditor are of different opinion, then it is a potentially matter for adverse, not even qualification. So this is something I request everyone to pay a lot of emphasis on. Sometimes in the matter warranting adverse, we end up giving qualification. So let's read the standard, and there is again an implementation guide on on the going concern, on SA 570. There is implementation guide on SA 700, 75 and 76 as well. So make sure you read those guidances, and you read the various examples which are given by institute in those guidances to which will help you actually to go through some examples and also understand the objective of the auditing standards better. Then this is something we have already maybe discussed in detail. So let's quickly see that. So in case the use of going concern basis of accounting is appropriate, but a material uncertainty exists. So this so material uncertainty is something I want that evaluate that very carefully. We'll see an example, and then we'll discuss about that in in detail. But since we are talking about going concern, so make sure that because it is ultimately the management who is responsible for the assessment of the going concern assumption. So make sure that we have the management's evaluation and assessment in place, on which as an auditor will audit that or will review that to conclude on our opinion on the going concern. So let's see again some illustrative language. So first is the use of going concern assumption is appropriate, but a material uncertainty exists. So if we read that para, so it is also being drafted in same fashion as EOM, but it is not an EOM, it is a material uncertainty para. We draw the attention to the relevant note in the financial statements. So that means management is equally responsible for disclosing in the financial statements that that we are preparing financial statement on going concern basis, but there are certain indicators. Also, those indicators are mitigating by a lot of factors. So let's read that language for a while. So it is saying that we draw attention to note this of the financial statement. Then we are highlighting that what are the factors which are indicating going concern issues, which is like a company has accumulated losses, their net worth is eroded, their current liability position is is negative. So with this, we are highlighting that there are certain indicators with respect to going concern which may cause significant doubt on the company's ability to continue as a going concern. So if after that you need to justify that how this is getting mitigated. So this is an example where the management the company actually received a support letter from one of their promoter. Okay, so now for mentioning, fine, we can mention that way in case the company has received a support letter from promoter. But as a part of our documentation, we need to have in the file the signed support letter from the promoter. We need to ensure that whether promoter is in a position to support the company. So in fact we should assess the net worth and the credit worthiness of the person who is giving the support, right? So it's not like it's not like anyone can give that support letter. So make sure that it is there along with the support letter, the evaluation of the credit worthiness and the net worth of the person who is giving the support letter is also there for all the logical reason. Then second, if we are writing that the company has favorable cash inflows, from its operations. So make sure we get those projections, we get those, cash flow projections from the management. And it's not like anything which is prepared in an Excel or Word is something which we are going to rely on. We need to test the underlying assumptions of those projections, right? Like what is the revenue growth which they have taken, how much expenses they have considered. So it should not be like the company has 100 crores revenue in March 22, but they are in projections they are saying they'll have 300 or 500 crores revenue next year. It may be possible, but you have to, again, check the underlying documents on that. What can be the example here could be, say, you check their order book, whether they have actually, significant orders from the prospective customers. Again, if they're saying they're going to work on their cost ratio, then you see that what measures actually they have taken to reduce their costing. Again, this is the whole idea is we cannot rely on anything which is given to us. Again, as an auditor, as a chartered accountant, we need to be professionally skeptical, and hence, we need to perform all those testing before relying on that. So again, mentioning anything in the material uncertainty para makes it all the more important that our documentation reflects that, and hence then only we can conclude on going concern. But in case we are getting a support letter from a person whose credit worthiness is doubtful, then it is again, it can be a qualification or even adverse opinion. Then again, we conclude the EOM with that it is, our opinion is not modified with respect to above matter. Then reporting under 143(3)(h). So this is again very important. There is a other reporting requirement in the audit report in which we have to report that, if the any matter which is reported in the audit report has an adverse impact on the functioning of the company. So this is again very important to be mentioned in our reports in all the cases. In case, the matter related to going concern may have adverse impact on the functioning of the company, so make sure we evaluate that and we report that. But in cases that impact is not there, but still evaluation would be required. There is a separate, again, implementation guide which is issued by ICI with respect to reporting under certain paragraphs of 143(3). So make sure we can go through that to practically assess in what situations or circumstances any matter can have a adverse impact on the functioning of the company. Then this is the illustrative language of a situation in which again, someone in the audience highlighted, if the financial statements are prepared on net realizable basis, then what should be our conclusion. So in that case, we can give a EOM highlighting that. So we are briefly highlighting that the company has discontinued its operation, and such events indicates that the company's inability to continue as a going concern, and hence going concern assumption is not considered appropriate, and accordingly financial statements are prepared on net realizable basis. And again, we give reference to the note in the financial statements, because it can be the reference to the note of the basis of preparation in the financial statements, and also the any other note wherein the going concern issues are highlighted. And then you conclude in the same fashion as the EOM is always concluded. Then again, there is another reporting in the audit report. So whenever it is a case of the financial statements being prepared on net realizable basis, make sure that the financial statement we report accordingly in 143(d). So this was the example which I was initially mentioning, that there can be certain matters because of which we need to highlight in a fashion that except for the impacts of this matter, everything is okay. So this is kind of that language, that except that financial statements are being prepared on net realizable basis, the aforesaid financial statements comply with the accounting standards. So this is something we are trying to highlight, because the going concern is the assumption that is always used, but because that assumption is not valid, so we are required to highlight in 143(3)(d). This is a language for adverse opinion, in which the going concern assumption is inappropriate and the auditor, do not agree with that. And with we discussed that whether or not the management agree for a disclosure or not, it warrants a adverse opinion. So again, in the basis for adverse opinion, we can highlight that the entity's financial arrangements are expired and they have this much of liability, and they are again unable to conclude on the renegotiations or replacement financing, and hence it indicates that the material uncertainty may exist, that may doubt, they may cause significant doubt on the company's ability to continue as a going concern. And we can also state that the financial statements do not advocately disclose this fact. Now I have a few quick FAQ. So I would like everyone that please participate in this one. So where an entity does not have material uncertainty regarding the entity's ability to continue as a going concern, should the management responsibility para continue to include the disclosure required as per SC 700? So in the interest of time, let's answer this quickly. So the answer is yes, because the management responsibility para provides summary of responsibility, including the going concern assessment, even if not, the company does not have any material uncertainty regarding the entity's ability to continue as a going concern. That responsibility is, always going to be there. If the auditor disagrees or is uncomfortable about the recognition, measurement, or disclosure or presentation of a transaction in the financial instrument, can he highlight the same as a EOM? Now this should be very easy. Okay, someone said it is yes. Okay, why we think it should be yes, because it is, we are saying that auditor disagrees or is uncomfortable. That means it can be a potential matter for misstatement. Then it can be only yes to the participant only when the impact of such the recognition, measurement, and disclosure problem is immaterial. If that is immaterial, okay, you can either give EOM, or you can not or you can consider not reporting anything in the audit report. EOM, when only it falls under the definition of SA EOM in SA 706. But EOM, again, as we highlighted, it is it is not a replacement, or it is not a substitute for modified opinion. So the answer is no. When the auditor's report is modified, does this impact the auditor's opinion or internal financial controls over financial reporting? I've not received any answer, I think, for this question. In the interest of time, I'll just move on. So the answer of this is generally yes, because when we are modifying the main report with respect to certain matter, so the idea here is that it can be yes, no, or maybe actually, but the idea here is that we always need to assess the impact. So whenever we are qualifying our main audit report, we always need to consider the impact of such matter in the IFC report, and also vice versa. In case we are putting qualification with respect to any, say, any controls or any cycles in the IFC report, make sure we evaluate the impact of the same on our main report as well. Sometimes even ICI also highlighted it in some of its sessions, that a lot of times we are putting qualifications or even disclaimer of opinion in the IFC report. especially in case of, smaller engagements on which IFC becomes applicable, say because, they just cross the threshold, which is there in the Companies Act, but, they don't have advocate system of internal control. So in such, situations, make sure we evaluate the impact of the same in our, in our main report as well. Sometimes, any qualification in IFC report can also, be questioned that how your main report goes unaffected. So for example, if you qualify that revenue process is not proper, then are we comfortable the revenue recognition is okay? uh, it might be okay, we are not saying that, but again, that is something we need to evaluate and document that in our file appropriately. So again, that's why I'm saying that this needs to be evaluated case to case basis. So let's move on to another part of our audit report, which is SA 701. We all know that it is on key audit matter. So let's briefly touch upon it. So key audit matters are basically those matters which in our the auditor's professional judgment, they're of such significance that we want to, as an auditor, we want to describe those matter in the key audit matter, along with the the audit procedures that we have done against against those matter. Now very important thing is that key audit matter are being selected from the matters which are communicated with the those charges governance. So again, the process of evaluating the key audit matters, everyone, is very critical. So make sure we review, we see that what all matter, what all the matters which were discussed with those charges governance, which warranted multiple discussions, which involved say involvement of any external expert. I'm not maybe always that, but these are some kind of indicators of a key audit matter. Then basically the essay itself gives a roadmap kind of a thing, that how you need to reach to the step of concluding that it can be a key audit matter. Then it was, again, we all know, and now we have already passed on few cycles, that was effective for the audit of financial statements for period beginning on or after 1st April 2018. Any examples of key audit matter? Which you guys would have seen practically? Okay, yeah, revenue recognition. It is impairment of goodwill, right? It is again one of the common example of the qualification. Oh, sorry, the CAM. So other than those questions, we can take up at last. I know I can see if your questions on the chat. We can take them in last. Valuation of inventory and provision for, so yeah, it depends case to case basis, but in case the valuation inventory involves maybe complex calculation, they involve significant judgment and from the management, and also some specific audit procedures done by us as an auditor. Recognition of revenue, correct, it is especially where it is complex, so absolutely correct. Let's see a few examples. So, someone highlighted in the group, impairment assessment. Generally, impairment assessment involves, performing specific type of audit procedures, and hence, and we, as an auditor, we want to, put that as a matter in the audit report. Then sometimes, even taxation matters, significant litigation, complex litigation, we can, put that as a key audit matter. Then revenue recognition, again, one of the very common CAM. Provisions and contingencies, again, this will be relevant on case to case basis. Industry IT system and controls, again, this is also very specific. So make sure we evaluate carefully before concluding on that, whether it's a key audit matter or not. Then there can be industry specific accounting treatment, which is which is happening in case of a particular organization. say, the organization which is dealing into turnkey projects which are very complex, and they involve they have, say, some 50-100 steps before they actually capitalize the asset. Before that, a lot of approvals, lot of test runs which are done. So it is again a very industry specific thing, and as an auditor we may have done a lot of deliberation on on taking comfort over those capitalization, and maybe a lot of discussions with management and expert would have been done, and hence it can be a matter of it can be a potential key audit matter. Then I would just like to highlight there is a material which is being circulated by ICAI. It compiles industry wise the camps which are being put in by the organized by various organization, which are obviously listed ones whose financial statements are available on public domain. So if you guys need practically any help on drafting of drafting of audit procedures, we can use that for reference purpose. But one thing I would like to highlight, those are company specific, industry specific camp. Even if you are using that camp for the same industry, make sure we edit that as per our facts and circumstances. So no, don't just copy paste that, especially audit procedures, because the other auditor may have done different audit procedures to audit that financial statement line item, and we may have done different audit procedures with respect to that. So make sure we can use that as a reference. It's a very good document, but make sure we don't we don't just copy paste that. This is a again some example of illustrative the key audit matter. So a few things that are required to be there in a CAM. Again, a lot of times these are missing. So make sure the heading there, the CAM has a heading. Then make sure the note reference is there in the CAM. Then because again it is a kind of like we are drawing attention to something which is already there in the financial statement. So make sure that note referencing is there. Then make sure the description of the key audit matter is there for the users to understand that what we are talking about. And thirdly, the facts which can substantiate that it is a potential why it is a key key audit matter. So if we see that we have so in this example it is written that the group has taken professional advice with regard to some claims, and these are ongoing, and there is a dispute involved, and the again the claim which is amount of claim which is involved in this is also very material, and hence this is being because this is being considered as a CAM. So it should be your key audit matter should actually highlight those relevant facts. Now, last thing on CAM is that, an interplay between emphasis of matter and key audit matter. Very, very, very important to differentiate between an emphasis of matter and a key audit matter. So again, when a matter has been determined to be a key audit matter, we are required to include this as per requirements of SA 701, and we should not use emphasis of matter or other matter instead of SA 701. So that means EOM or other matter cannot be used as a substitute for reporting a key audit matter. So again, this requires a lot of efforts in terms of understanding the client, understanding the area which we are auditing, what kind of audit procedures we are doing, how we are going to disclose in the financial statement. So make sure we consider that before we conclude on it's whether it's a CAM or whether it's a EOM. Then there may be a matter that is not determined to be a key audit matter as per SA 701 because it required significant auditor attention, and the auditor's judgment it is fundamental to the user's understanding of the financial statements. Then it is a matter for the EOM, and it is not a key audit matter. So make sure we understand the difference between the two, and we accordingly report that in the financial in our audit report. Now, this is something we are going to talk about now. The various the reporting that auditor responsibility has with respect to the information other than the financial statements and the auditor's report. So let's quickly get into this. So this is again, as you all know, it is governed by the requirements of SA 720. So management is obviously responsible for the preparation of the other information. So we are not responsible for that other information per se. Then that other information we may either receive before the date of audit report, or or it can be expected to be made available to us after the date of audit report. Now we'll see quickly in the next illustrative which we are going to see, that what impact it is going to have from the perspective of our reporting, whether in case it is obtained before the date of report or in case it is obtained after the date of report. So and also it is neither an opinion or it is nor any kind of assurance or conclusion. It is a reporting, but we as an auditor are not giving any opinion or assurance on the other information. Our responsibility is to read the other information and to ensure whether it is materially consistent with the financial statements. It should not be materially inconsistent with the financial statement. In case it is inconsistent, then we are required to report that in our audit report. So that means that if there is a material misstatement, then we have to state the same in the same section. And also, in case such misstatement, we also need to consider the impact of such misstatement, if it can lead to a modification in our audit report. Now let's see a few illustrative language. So it is a case wherein so it is a very simple case basically, wherein we have obtained all the other information prior to the date of audit report, and we have not identified any material misstatement in that. So now please focus on this example, because next few examples I'm going to quickly run on, because largely the content of the reporting would be same. It's just that factually you have to change. So in this case, we will say that the companies, we discussed that, right? The company's board of directors or management is responsible for other information. Then we have to describe what is included in the other information. Now this is very important. So again, the other information can include, say, your annual report, your director's report, or say any other report which is going along with the financial statements in some or the other form, right? But it does not obviously include financial statements and auditor's report. So first paragraph, we highlighted that. Next, we highlight that our opinion on the financial statement does not cover other information, because we are not giving any opinion on that. We are not giving any kind of express assurance on that. And thirdly, we highlight that it is our responsibility as an auditor to read the other information and determine that whether it is materially inconsistent with the financial statements. And if we conclude that there is a material misstatement, we are required to report that fact. But because in this case we did not identify any material misstatement, we will say that we have nothing to report in this regard. So this is going to be largely the language of this paragraph. Now let's see another case wherein we have not actually obtained other information prior to the date of audit report, but it will be made available to us after the date of audit report. So when this will happen? This will happen basically in cases like say a listed company, right? They generally do not prepare their annual reports immediately at the time of signing of the auditor's report. They take some time, because the Companies Act also gives them that much deadline to submit the annual report. So we don't have the annual report as on the date of the signing of the auditor's report. So in that case, we have to highlight that in our audit report. So it's not like one illustrative language which is, say, given in the essay, or which is there in the public domain. We are required to use that. Please see your facts and then update your language. So in this case, we are highlighting that the XYZ report is expected to be made available to us after the date of audit report. And then second is same. And then in third, we are saying that we will read that when it becomes available, and then we will see that whether it is inconsistent with the financial statements. And then lastly, we can highlight that when we read X report, if we conclude that there's a material misstatement, we are required to communicate the matter to those charged with governance as per requirements of SA 720. So this is something, again, this structure of the language is again very important, based on facts of the case. So in case you're auditing a listed company which is not giving you the annual report, make sure we amend the language in the same fashion. This is a case, wherein we have obtained no other information. So the how it is different from the other one. In this case, in the previous case, we got the we said that we'll get it at a later date. In this, we are saying that we'll not receive this at a later date. So this is more of you will encounter in case of say private limited engagements, wherein you did not receive the other information, and you may not receive it in future also. So in that, it's a very important that we highlight in the reporting that I'm sorry, that uh, that X report is not made available to us at the date of the audit report, and we have nothing to report in this regard. So make sure we highlight that specifically in our reporting. Next is a classic example in which there is a misstatement. It is this something you will see rarely, because largely we either we are comfortable with that, or we say that we have not received that. So in case that in case that is the case, the first para largely remains same, in which we describe the other information. We say they are responsible. Secondly, we highlight that our opinion on the financial statement does not cover other other information. And then we said that when we read the other information, we have identified a material misstatement, and lastly you conclude with the description of the material misstatement of that other information. So this with this we are done with the talking about essays. Now let's move on to other reporting requirement. So we'll talk about 143.3. We'll also talk about few aspects of CARO. So let's start with that. So first point here is whether as an auditor we have obtained and sought all the information explanation which to the best of our knowledge and belief were necessary for the purpose of our audit. And if not, then we have to give the details of the same and the effect of such information on the financial statements. So this is something you need to report it factually again in other legal and regulatory reporting. In case we have not obtained all information and explanation, say we have a qualification highlighting that, then we may start with, except for the effects of the matter described in the basis of qualified opinion, we have obtained all the information and explanation. Then B is whether, in our opinion, proper books of accounts as required by law have been kept by the company. So again, please modify this para factually. In case there is a qualification highlighting the maintenance of books of accounts, then we have to give reference to that. Then C would be applicable, in case, there are, the company has branch offices, and those are, audited by a person other than the company's auditor. And we then, then this is where we are required, where we will be required to report. Then whether the company's balance sheet and profit and loss dealt with are in agreement with the books of accounts and return. So again, these are the reporting requirements which are there under the Companies Act 2013. So make sure we align with that before concluding in our reporting. Then whether in our opinion financial statements comply with accounting standards, again very important to highlight. We just while discussing SA 705, one of the person in the audience gave an example that non-compliance with Ind AS or AS is a can be a potential matter for qualification if the impact is going to be material. Then in this para, make sure we highlight that maybe in the same fashion, again, except for the effects of the matter described in the basis for qualified opinion, the financial statements comply with the accounting standards. So make sure that whatever we are reporting in the report, it is consistent at all the places, like we discussed in going concern, right? That at one place we are saying that there is material uncertainty. Then we'll see that later on. Then in CARO, we all know, right, that in CARO also there is additional reporting requirement on going concern. So then your CARO reporting should be in line with your main report. Similarly, your reporting in the main report should be in line with the reporting in the other reporting under other legal and regulatory points. Then the observation or the comments of the auditor, which may have the adverse impact on the functioning of the company. So this is again very important. I gave an example of this. So if there is a going concern issue, which may have adverse impact on the functioning of the company, we need to highlight here. And we need to highlight in the fashion like, the matter described in the basis for qualified opinion, or the matter described in, say, material uncertainty or going concern even may have the adverse impact on the functioning of the company. And if you need more guidance on that, then there is an implementation guide on this. Please refer that. Then again, this is continuing from ages, in case if the director is running disqualified under section 164(2), we are required to obtain that declaration from the directors as on 31st March every year. So a lot of times client comes to us and tell us that we give that declaration to you last year, why you need that in current year. So make sure we take that every year. The situations may change, directors interest, relationship, investments, all these things can change. So make sure, we obtain this declaration, as our audit evidence every year. Then any qualification, reservation or adverse remark relating to the maintenance of accounts. Again, link this to your reporting in the qualification adverse or disclaimer of opinion paragraph, and accordingly reported here. Then where the company has advocate financial controls system in place. So here generally we give reference to our IFC report, right? So there can be two situation here. Situation one, that IFC is not applicable. So there we will say, we will give reference to the notification of MCA that by this notification the IFC is not applicable, and hence we are not giving any opinion on that. Or second case, IFC is applicable, and there is a separate annexure in which we are giving our IFC opinion. Then make sure we give reference to that annexure, right? Then last is any other matters as may be prescribed. So there are actually certain other matters which have been prescribed. So let's get into that quickly. So these are ones which are continuing. First is whether the company has this any pending litigation. So make sure we update that factually. If there is a litigation which is getting disclosed, say under the note for the contingent liabilities, then we give reference to that note, and and we report this the fact factually here. Then whether the company has any such long-term contracts on which they can be material foreseeable losses, then make sure we report that factually here. And in case there is a note reference which is required, make sure you give that note reference to the financial statements. Then in case there has been any delay in transferring the funds to investor education and protection fund, then we need to report here factually. And again make sure generally it will this will not be applicable to a private limited company, because those generally do not distribute dividend, and it is generally in case of it is generally applicable in case of listed companies. So make sure we are not doing the copy paste thing. We are reading the section, we are reading the standards on auditing, and then we are considering the report, the impact of the same on report. Now, this is something which is, again, I highlighted initially, this is not new, but still new. We are just trying to, absorb it. We are trying to evolve on it. So on March 24, 21, the MCA amended the company's audit and auditors rules 2014. This was effective from 1st April 21. And so it is applicable to the reports which are issued after 1st April 21. So again, we know the answer to this question. It is actually applicable it was applicable for the reports that we issued for March 22. So I'm sure you all have worked practically on audits or reporting last year would have done this reporting. Now quickly see that. So this was rule 11 E. Again, let's read between the red highlighted portion is kind of which draws the essence of the section. So it starts with whether the management has represented that that to the best of its knowledge and belief, other than as disclosed in the notes of accounts, no funds have been advanced, loaned, or invested either from the borrowed funds or from the share premium by the company to any other person or entities, with the understanding that which is either recorded or otherwise, recorded in writing or otherwise, that the intermediary shall directly or indirectly going to lend or invest in the other person, or even provide a guarantee or security on behalf of the ultimate beneficiary. So this is, again, this is theory, we all know that. So again, in the interest of the time, instead of reading this, I'll just get into a few examples so that we can, we can understand this. But just to summarize, the first talks about the advancement of the funds, or the giving the funds whether in the form of advance, loan, or investments. And the second talks about the receipt of funds. Again, the receipt can be in any form. It talks about substance over form. So and lastly, the third talks about so again, the first two talks about what management has represented to us, and third, it talks about what audit procedures we have done, and based on such audit procedures, do we think that the representation which given by the management is correct, or is correct or not. So that means, initially a lot of people thought that, are we going to rely only on the management representation? The answer is no, because in the third para, we are required to report the our conclusion as well, what audit procedures we have done, and whether based on such audit procedures, whether we think that a representation contained in subclause 1 and 2 contain any material misstatement or not. So I'm sure we have done one cycle, but and we would have observed that we have to apply our, we have to apply a risk assessment and approach, maybe in a new way, to design our audit procedures with respect to with respect to reporting such clauses. This is complex. This involves a lot of professional skepticism and judgment. There is no doubt about it. It involves detailed understanding of the transaction, right, that to understand whether the objective of movement of funds was for that purpose. And we all understand what was the the objective of bringing in those amendment. The objective was to a lot of the transfer of funds here and there was happening in the name of say investments, and and things like that. So to catch that, to cover that, such kind of amendments were brought in by MCA. And we all again know that the corresponding disclosure is required in the financial statement as well. So last year schedule 3 was also revised, and as per requirements of schedule 3, such loans and advances are now required to be disclosed in the financial statements as well. So it is a corresponding amendment both in the financial statements and in our audit report. So, so that's why I said, instead of understanding it theoretically, let's understand this with the help of quick diagram. So, say this is a this is a funding party, or we say we are saying reporting entity. So it gives any funds, whether it's in the form of advances, or it is in the form of loans, or it is in the form of investment, to any person which we are terming at intermediary, and it either again gives advance, loan, or even it includes guarantee or security to any other person but on behalf of the funding party. So if we identify such transaction, that it definitely warrants the reporting. Now here, lot of, again, I'm continuously saying this, lot of judgment is involved, and before judgment, I would say detailed understanding of the transaction is involved by us as an auditor, to understand that whether it warrants a reporting. Here we need to understand that who is the ultimate beneficiary in the transaction. We need to understand that if actually the advancement is happening on the base, on the behalf of funding party, and if we management tells us there is nothing, so practically I've experienced that there's no such advancing which is happening on behalf. It is these are independent transaction. Then as an auditor, I need to see the evidence of that. I need to be comfortable with that nothing is happening on behalf, and it is, and those are there has to be substantiate reasons, to say that these are the independent transactions and not happening on the behalf of the funding party. So in case it is falling, then the reporting under rule 11E1 would be required. So as I said, one is about advancing and second is about receiving. So now if we say, so there, if we all see, it was the reporting entity. That means we are giving opinion on that. Now the reporting entity is the intermediary. Now, if such intermediary has received funds from the funding party, which it has lent or invested or given security or guarantee on behalf of the funding party to the ultimate beneficiary, then reporting under Rule 11E2 would be required by this company, which is the reporting entity in this case. So it might be possible that one transaction is getting reported in the company or in the company A and B both. For example, A was the funding party and B was the intermediary. Then in A books, it is coming under Rule 11E1, and the B books, it is B audit report, it is coming under Rule 11E2. Now, quickly look into few case studies, which are, which will help you again to understand this concept better. So say if, again, now I quickly need your participation. So I know we are running short of time. I need to cover a few aspects more in this session to achieve the purpose. But for that, I need, all of you to, participate so that we can conclude this, on time. So the first, everyone can see the questions on their screen. So, so anyone who would like to answer this quickly? Any answers? Okay, so in the interest of time, I'll quickly move on to answer. So in this case, the X will not be considered as a funding party. The answer is because in this whole transaction, there is no arrangement of funds. There is no transfer of funds that has happened. So X has also given guarantee to B, and B has also given a counter guarantee to C on behalf of X. There is no money involvement in this transaction. Although we discussed that even guarantee and security are covered, but the again, the whole objective of the government is to get into those transactions where the embezzlement of cash or or money is happening. So this will not be covered under Rule 11E1 and 2. Now, if A gives loan of rupees 100 crores to B, who based on such loan provides guarantee in the favor of C, what are the reporting requirements for A and B? Quickly. So let's see. So reporting by A will be required because it is a funding party. So this is a why it is different from one, because in one there was no flow of funds, but in this, although B has given a guarantee in the favor of C, but A to B the transfer of funds has happened. So reporting by A will be required because it's being a funding party. And further, though there is no funding by intermediary to B2C, reporting under Rule 1182 will be required by will require to be given by B in this case. Now, next example, A lends money to B for onward investment in C on behalf of A. What are the reporting requirements for A and B? Sorry, I'm not waiting much. You guys have to be quick, otherwise I'll have to move on again, because in the interest of time. So the answer is reporting under Rule 11E1 will be applicable. So again, we discussed that, right? It is not only giving loans or advances, even the investments are covered. So in case A give money to B, it was a loan, but B did further investment in C. B did not give any further loan. So will it not warrant Rule 11E reporting? No. The answer is it will warrant Rule 11E reporting because even investments are getting covered. So X, a company which is in UK wants to acquire a company Y in India through A. It's wholly owned subsidiary in India. X provide funds to A through infusion of capital, and A is obligated to use such capital for the acquisition of investment in Y. What are the reporting requirements under Rule 11E? So reporting under Rule 11E2 will be applicable to A, right? Because A has actually used the funds for the purpose of making the further investment. So naturally, because X in this case is a is a foreign company which is not governed by Indian regulations. So that is why the Rule 11E1 is not applicable to anyone in this case, but Rule 11E2 is applicable, to basically A in this case. Again, this is a quick example that where there is no written understanding, that again, that intermediary is lending, investing on behalf of the funding party. It is important to understand the timings of the cash flow. So I said that a lot of people must be facing challenges, that how we need to determine that it is actually warrant reporting under Rule 11E1 or 2. So and a lot of times, in case of such transactions wherein the company wants to wants to flow funds in a certain way, even the written agreements are not there sometimes. So in case there are no written agreements which can establish that who is doing what transaction on whose behalf, who is the funding party, reporting party, or the ultimate beneficiary, please see the timing of the cash flow. So if we observe that, like in the previous example, the holding company gives, say, money to say, in that question A, it gives money to A, say, on say 1st of March. On 5th of March, those are being further used to make an investment in the other company. Then maybe the timing of the cash flow, and if the amounts are also nearly the same, it is actually professionally skeptical to say that the Rule 11 reporting may be warranted in that case. Again, you have to do the detailed evaluation, you have to do more fact finding, but such circumstances again indicates that it may be a potential matter for reporting. Now last example is if A funds sorry if A funds 100 crores to B in year 1 for onward funding to C on behalf of A, B funds 100 crores to C in year 2. Again, and at the end of year 1, B has a cash and bank balance of rupees 120 crores. There is no written understanding between the parties. Can it be considered as the fund advance by B to C from the funds it received from A? So again, here the timing is something which is to be understood here, because A gave funds to B in year 1, and and B again further use those funds in year 2. So it should be considered in year 2 that funding by B to C was for the funds received from by B from A. Since in year 1, the year-end cash balance was more than the funds received from A. So basically, it is trying to say that in year 1, it may be possible no reporting is required, but in year 2, definitely reporting would be done. So after this amendment on Rule 11E, there was another amendment with respect to the specific reporting on the dividend declaration and payment. So again, make sure we check all the advocate documentation before commenting on dividend payment and declaration compliance with the requirements of Section 123. So again, maybe as a audit procedure, this is something which we were already doing even before this amendment, but we need to be a bit careful now with respect to that it is advocated documented. Anything which is warranting reporting in your audit report needs underlying documentation. I mean, everything needs underlying documentation, but something which is going in the report becomes all the more critical. So it is a factual reporting. I don't think so there are any complications in this. It's just that you need to consider both final payment of final dividend and interim dividend while reporting under this clause. Then clause G, it is something which is futuristic. So it is applicable for the audit which is beginning from financial year 2022. So probably from next year we are going to report on report on this clause as well, which is on audit trail. Again, this is something futuristic, and we believe that ICI is in process of preparing a detailed guidance note, which will help us in understanding the expectation. Then what is again what is going to be the responsibility of the management, what is going to be the responsibility of us as an auditor, and hence so again, all of those who are working practically on the engagements, make sure you start pushing and I think you should have already started pushing the client to have such accounting softwares and other things in place which can ensure that that they have a feature of audit trail, they have a feature of edit log, and that again they have to give us sufficient evidence that it has not been tampered with and it has been preserved by the company. So this is something, again, this is futuristic. You would have to maybe involve some IT experts to take comfort over this reporting. So this is again, we need to prepare ourselves for this as well in future. This is the illustrative language with respect to reporting under rule 11E 1, 2 and 3. So again, this is there absolutely in the implementation guide, which was circulated by ICI in April 2022, which gave a lot of examples, a lot of case studies. So again, maybe while working practically, those can be referred. So I'm just not wasting much time on this. Then other than that, there are other illustration language as well. So there can be situation in which the funding has happened in the year one, and the understanding of the intermediary onward lending, that the example which we just saw, is happening in year two. Then how we need to conclude on our reporting. Then in case we are giving a modified opinion on rule 11E1, then how that needs to be drafted is something which is readily available in the implementation guide. Now I'll just take some time to discuss on CARO reporting. I just appreciate everyone's patience here, but considering the importance of the matter, I would like to cover a few important things on this topic. So CARO reporting is also something which underwent a lot of change last year. A lot of new clauses that were added, lot of modifications to the clauses which were already in existence, and then there was one clause which was deleted on account of repetition, which was relating to manager remuneration. um, then okay, so I'm just quickly discussing the significant changes only, because CARO itself is a very vast topic, and if I want to discuss this and that in entirety, then it would require a separate session. So I'll just discuss few important aspects with respect to CARO. So first is this clause is on the reporting of unrecorded income. This is a new clause. It requires warranting when it requires reporting when any income is voluntarily surrendered or disclosed by the company. Then again, very some important facts that need to be considered is, in case any addition is made by the income tax officer by virtue of the assessment, then it does not fall under the scope of that. It doesn't fall under the scope of the reporting. So even if some people ask that even if the company has not filed an appeal to that addition that has been made by the income tax officer, it does not mean that company has voluntarily offered that. So we make sure we go through the wordings carefully and accordingly determine our reporting. So this was again one of the new clause that was added last year. Again, I'll just highlight 2-3 examples. So if a company disclosed or surrendered unrecorded income other than voluntary disclosure, does the same is required to be reported under CARO. So in such situation where undisclosed income are surrendered or disclosed on the ground that the disclosure was obtained under force or coercion, it it cannot be treated as surrendered or disclosed by the company. The disclosure should happen voluntarily by the company, which is a critical term. Then if any addition of income was made by the income tax officer, this I've already explained, so I'll quickly move on from that, because we discussed that already. Then this is again one of the very important clause which was there in the previous version of CARO as well. but underwent significant changes. Now, along with the fact that whether management or us as an auditor identified any fraud during the year, we are also required to report on the whistleblower complaint. We are also required to report on the filing that have been done, as per the requirements of section 143.12. So again, this is something as per the requirements of ISA 240 and 143.12, we were already required to perform relevant inquiry procedures with the management, whether any material fraud was identified, during the year, or we as an auditor always had the responsibility in case we identify any material fraud. We are required to report to that, to the central government in case the amount and the exceeds the applicable threshold. But it's just that now we are also required to specifically report in the in our CARO report. So, it has basically the three subparts. One is on whether is on reporting of fraud. B is on if the auditor has filed any report in the form of ADT4 to the central government, and C is on whether the whether any whistleblower complaint has been received by the company. So this is something which is very important. Some companies may have a formal vigil mechanism policy, or may have formal process in place to take into account the whistleblower complaint. Some companies may not, but it does not escape us from our reporting. We are required to inquire from management whether they have received any whistleblower complaints, and we are required to mention or report those whistleblower complaints in our audit report with the relevant facts. One key point is that in case the cost auditor or the secretarial auditor has done certain filing under 143.12, then the fact should be reported in our CARO report also, and we should obtain the written representation from the management with respect to that as well. Now let's see few case study. So say ABC, there is no mandatory requirement for establishing a whistleblower mechanism. Whether the auditor of the company is required to report under the said clause. The answer is yes, because even if there is no mandatory requirement, the auditor can ask the management that what all whistleblower complaints were received, and how those were dealt with by the management. So it is not like if the company does not have any mechanism, or if the company is not governed by say SEBI LUDR, it doesn't mean that we are not required to report on this clause. Auditor has during the year unearthed the fraud and reported to central government. Whether this is to be reported under CARO, the answer is yes, because all types of all types of fraud are required to be reported, whether identified by management or whether identified by us, or even if we have already reported to the central government, it does not escape us from our responsibility from reporting in the CARO as well. But just again, practically, whenever you are doing any reporting in CARO under these under this clause, make sure that you also evaluate the impact of the same on your main audit report as well. We understand that CARO is a factual reporting, but your audit report in as a set, like including IFC, CARO, and your auditor's responsibility, those should all be consistent. So make sure we consider the impact of any matter, especially this clause. We consider the impact of the same in the main audit report as well, that it is not having any immaterial impact on the main audit report. Then these are few quick illustration. Again, they can be n number of permutation and combination. They can be fraud identified by management. They can be fraud identified by us. They can be reporting done by management, or they can be reporting done by us. So we need to report that factually. So this is an illustrative example which is giving us that how we can report the same. So this is for this is for clause 11A, and this is for clause 11B. Then again, where the company has received whistleblower complaint, we'll write that we have taken into the consideration the whistleblower complaint received by the company during the year, while determining its the nature, impact of the extent, while considering the determine the nature, timing, and extent of the audit procedures. And in case no whistleblower complaints are received, then CARO, as we say, it's a factual reporting. Then we'll write that there are no whistleblower complaints which are received by the company during the year. Then again, the internal audit reporting was, again, it's a it's a new clause per se with a with the specific requirement to include to consider the report of the internal auditor. So earlier we were required to comment that whether the company has an internal audit system in accordance with its size and nature of business. But now the clause requires us to specifically report that whether the that auditor has considered the report of the internal auditor, and in case there are the internal audit reports are not available, or there are qualifications and or there are some observations in the internal audit report, then we have to consider the impact of the same in the either in our the audit procedures, or if required in our audit opinion as well. Let's see a few illustrations. If we say the company has an advocate internal audit system, the reporting would be very simple. But it might be possible the company does not have an internal audit system, though it was mandated under section 138. Then again, we'll require to report the same fact that the company is required to have an internal audit system, but it does not have established the same during the year. And third can be the company did not have internal audit system, but it was not mandated also for it to have it, under section 138. Then we'll do the factual reporting, which is like the company does not have internal audit system, and it is also not required to have that as per the provisions of the Companies Act 2013. So again, please don't do any copy paste. Evaluate your facts and then determine the reporting under CARO. Then internal, again, there can be other illustrations as well. This is with respect to the reporting under the subclause, which is for the consideration of internal audit report. There can be, situation when we have received internal audit report till a particular date. So make sure we mention that. And in case we don't receive that, we need to write that the company did not have an internal audit. Again, illustration 5th is influenced by the earlier illustration, in case the company does not have internal audit system, or it is also not required to have. Third, the illustration 6 is more for a it is a qualification in a CARO report that the management did not that we provide us the internal audit report, say for this period, and hence those could not be could not be considered by us. But very important aspect in case of such situation, we have to consider that whether it has an impact in our IFC report, because it can be a material weakness in the internal control. Then reporting on cash losses. This is new clause from the perspective of CARO 16 and CARO 20. But those who have worked even on the CARO, which was in existence before 16, this clause was there. So it is a kind of, it is brought back actually. So this is again, again a factual reporting. So make sure that, cash losses is not defined in the Companies Act as such. So we, or even in the accounting standards or Indian accounting standards, so we need to carefully determine that what we are considering as a as cash losses while again evaluating our reporting under this clause. Second, here the third point is very important. If the financial statement is prepared in accordance with accounting standards, and the figures of, say, net profit or loss is adjusted with non-cash nature expenses like depreciation, then we need to again maybe calculate the cash losses, and then it can be a situation where there are cash losses, because the profit is determined based on certain non-cash items. Then this is again a new reporting, which is on the auditor's resignation. Again, I agree that it is a factual reporting, but make sure we look into the guidance by SEBI and look into the guidance which is there by ICI on resignation. So resignation is again not very simple even now. Earlier also we discussed that, right? Even scope limitation cannot be a simple reason for resignation. We have to evaluate a lot of aspects from the perspective of SEBI and our institute before considering to resign from an engagement. And it requires us to report on the resignation. So in case the tenure of the auditor is completed, then it is not a matter of reporting under this clause. Then again, what are the matters that an incoming auditor is required to consider in case previous auditor has resigned? The incoming auditor, this is again we all know already the incoming auditor who is required to report on this clause, we need to take into account in the following the ICAI code of ethics, whether we got the response to NOC, whether he has filed all the forms, and whether he has given the proper resignation letter, and his resignation letter does not give any any objections which should concern us as a incoming auditor. Is the required auditor required to report in case the auditor has completed the term? The answer is, we have already discussed. The answer is no, because in this, that is not a case of resignation. So this warrants a reporting only if it is a case of resignation. These are again some examples of illustrative language. In case there is no resignation, we just report it. It is because there is no resignation, the provisions of this order is not applicable of this particular clause. And in case there is resignation, there can be two factors. There can be two situations. One is the auditor has raised concern. So we'll say that we have to take into consideration those issues and concern. Second possibility, the auditor has not raised any concern. So we'll say that there were no issues or objections raised by the outgoing auditor. Then reporting on financial position, I would just like to emphasize a lot on this, because it has a linking to our main report. We all discuss material uncertainty on going concern. We'll all discuss a lot of aspects with respect to going concern. So now the going concern has even one more area of reporting, which is this clause in the CARO. So make sure your reporting under this clause is inconsistent with the reporting in your main report. So if you're reporting in the main report, there are no going concern issue, there is no material uncertainty on going concern para, there is no qualification or adverse, then your CARO reporting should be in the same lines. It should not be like, here we are reporting that there are going concern issues, there are indicators of going concern, but in the main report we are not doing any reporting. So similarly, vice versa. So this is again, just want to quickly highlight that please make sure that it is consistent. Then so basically, if we read through the language, we are not again giving any we're not giving any assurance that the company will be able to continue its business. But like SA 570, because we are responsible going concern assumption. So based on certain factors, we are required to give a factual reporting. So let's see one quick illustration on that. So this is an example which is there in the guidance note itself. So it says that, based on the information explanation given to us, based on various financial ratios, and, the expected dates of the realization of the assets and liabilities, nothing has come to our attention which causes us to believe that any material uncertainty exists as on date of the audit report. So this would be mostly the case when there are no going concern issue. But here the last, statement is very important, that we further state that our reporting is based on the facts which are there up to the date of the report, and we do not give any guarantee or assurance that the company will be able to pay off its liability, or as and when they fall due. That means we are reporting based on certain facts which are like reviewing certain ratios and seeing the position of assets and liabilities, but we are not giving any assurance as such. Then reporting on CSR compliance, there is no per se change in the CSR section. There were certain amendments which came in 2021 after, but this is just a factual reporting on on the CSR compliances that are being done by the company. So it is divided into two sub clauses. One is on requires reporting on the in respect of the other than ongoing projects, and the other requires a reporting in respect of the ongoing projects. So here I'm sure on ground you guys would have a lot of doubts, because the act gives a certain time, like it gives 6 months and 30 days to transfer the funds or to spend the required amount. But but we are giving say opinion in the month of April or in the month of May, when 6 months are not expired. Then fortunately the CARO report also, the guidance note on CARO also has a illustrative language to cater to such requirements. So I'm not getting into the detail of section 135. So this is the language. In case the provisions of section 135 are not applicable, then we are required to report that. But in case there are non-compliances, then we are required to report that as well. One very important point I want to highlight is that reporting is required with respect to current year and also previous year. So this is again, we need to be mindful of while reporting under this clause. This is the clause which I was talking about, that this is the example in which we can write that although the amount is not transferred to a fund specified in Schedule 7, but the specified time period of 6 months has not been expired. So this will give a comfort to your client that we are not giving qualification because clients still have time. This is the various illustrative language with respect to ongoing projects. Again, you can refer the guidance note on CARO, for this, there was a latest version also which was released in this year, 2022. So make sure we refer that updated version for some updated languages and guidances and in the guidance note. Then we have reporting under consolidated financial statements. This is again very important. This was a change. Now we are required to see if there are any qualification in the report of the auditor of say subsidiaries or joint ventures, and we are required to report those qualification in a consolidated report. So there are mixed practices here. Some firms are reporting in their main report. Some firms are giving a separate annexure to their consolidated report. That is as per the practice of the CA in the absence of guidance by ICA till now. But make sure we report that. And reporting again is required only if there are qualification and adverse remarks in the CARO report of the subsidiaries or associates. In case there are no subsidiaries associates, then we are required to report the same factually in the CARO report of those of the main entity, that we say that there are no subsidiaries and associates and there is no reporting required. In case there are no qualification, then you can report in your console report that there were no qualification in the CARO report of the subsidiaries, associates and joint ventures, and and move on. And this illustration too would be done maybe in your console report, or you prepare a separate annexure for that. In case there are qualification in or adverse remarks in the CARO report of subsidiaries, then we are required to report the same factually. And in fact, one important point to be considered, that even though the holding qualification adverse remarks are already coming in the standalone CARO report of that holding company, but we are required to reproduce even the qualification or adverse remarks in the holding company as well. So with this, we are done with the CARO. We are at the verge of concluding the session. With respect to consolidated audit report, majority of the facts I have discussed. I have discussed CARO. I have discussed you have to be mindful in case there are financial statements audited by another auditor. There are financial statements not audited, though you should conclude that those are not material. So make sure we take care of those facts while preparing our console audit report. And there is again guidance note by ICA with respect to consolidation. So refer that in case you need any guidance. Then lastly, a few quick reminders. We have to assess, whether qualification or any material uncertainty have an adverse impact on the functioning of the company. There is a separate subsection 143 in 143.3, which requires reporting on that. Any matter reported in the audit report, make sure you evaluate the impact of the same, whether it has an adverse impact on the functioning of the company. And do not just delete that or do not just put that. Make sure you have the evaluation. Understand the difference between special purpose, general purpose. Special purpose is governed by SS 800. It is with the specific restriction on use, and general purpose is generally the Companies Act statutory audit report which we issue. Then this also we discuss the impact of qualification or other reporting in the IFC on main report, or even vice versa. Then CARO, amendments, you link those amendments with the required disclosures as per Schedule 3. Then you also, look into the amendments in Rule 11E and F. And lastly, there is the futuristic change, which is going to be there is on the audit trail. So with this, we discussed a lot of aspects with respect to audit reporting. My apologies for taking extra time, but considering the importance of the topic, I did not want to skip that. Thank you so much, everyone, for your patient listening. I hope I was able to convey the topic. In case you have any questions, we can take that. Thank you.
Members, do we have any questions for ma'am? In case if we've got, we can definitely have in the Q&A.
So someone asked in the chat that do we have any sample wordings available for key audit matters? So I
Mhm.
said that there is a guidance compendium type of thing which is being issued by ICA, I think 2 years back. So you can refer that. It has compiled the CAM from various industries.
Sure, sure.
Then if you guys have other questions, please post
Please
that
share
on.
PPT. I think that will be the entire session will be put up on the our YouTube and the record. I mean the PPT will be put up on the WRC website, sir. Sure. Any more questions? Great, great, great. Should we move towards the vote of thanks, ma'am? Unless we've got any questions or anything else. I think there are no questions from the audience. Harsh, ma'am, are you there?
Yeah, I'm there. I'm there.
Sure, sure. I think it's a pleasure, ma'am. Absolutely, it's fine to exceed the time, but the knowledge. In fact, we should be thankful to you that in spite of you know, in moving ahead of the time, you took that time and to explain because, as you said, those are important matters. I think I love the last sentence that you had in your presentation.
Yeah.
We all start with trust. I think without that, our profession would not survive. We all work on that. I think that that's a key basic where we start our audit or
Right,
vouching rather form. So
right, right.
I think I loved that thing. I think the way that last, and I'm gonna be using that in my session. I'm gonna be taking that from you and definitely credits to you. Thank you, Harsh ma'am, very much for being an excellent speaker and holding up the audience for this excellent session. And audience, I think thank you very much for being there. I think this entire series of auditing standards that the WRC is doing, series 1, 2, 3, we've got a great response and we can actually understand the need for this program. And we're very thankful to all the faculties, including our today's faculty, CA Harsh Batra ma'am, for removing their time and guiding us, guiding our entire audience set on this important topic. I'm sure in our further webinars as well, we look forward, of great audience participation. Thank you so much. This is CA Rudiesh Pankhania, the Regional Council member from the WRC. Thank you very much once again, everyone. Thank you, ma'am.
Thank you, sir. Thank you,
Thank
everyone.
you.
Thank you.
Mishra ji, can we just officially close?